Every month, I try my best to identify 5 stocks that I think are looking interesting in the stock market. However, I do have to admit that it has become increasingly more challenging with the S&P 500 continuing to hit all-time highs and stocks seemingly going up every single day. With that being said though, I have still found 5 stocks that I think are looking interesting for the month of December. And the first one I think will really surprise you. So let's just hop right into the video. And the first stock is KSPI, which is Kaspi.kz. Now this stock IPO'd all the way back in 2020, and since then, the stock has more than doubled and is now up 101.6%. However, the stock is currently in a 21% correction from its all-time highs, which is increasing its attractiveness to me. So let's discuss what Kaspi does. Kaspi operates the largest consumer-focused ecosystem in Kazakhstan. They are the #1 spot for digital payments, marketplace, and fintech in the country. Kaspi's super app serves as a single window into their ecosystem and offers bill payments, marketplace, digital banking, consumer financing, messaging, mobile commerce, and more. The business also has 3 key segments, which are payments, marketplace, and fintech. All of these segments are seeing very strong growth, with marketplace growing the fastest at 43% year over year. In total though, the company did grow its revenue by 28% over the past year, and its net income is also up 18%, so the company is growing quite quickly. The diversification of its earnings or net income is also split almost exactly into thirds. Kaspi also says that its future growth will most likely come from marketplace and payments though, and fintech will become a smaller and smaller portion of the business's earnings. For example, their e-grocery business saw gross merchandise volume growth of 88% year over year and 2.4 million purchases in the third quarter alone. The average ticket size per purchase is also up 74%. Marketplace purchases are also accelerating with 45% growth in the third quarter versus 39% growth over the past year. And since the growth in the most recent quarter is faster than the year-to-date growth, again, this does suggest that the business's growth rates are accelerating. Every business line over at Kaspi is attracting new customers as well. Payment active consumers are up 7%, marketplace is up 14%, fintech consumer deposits are up 20%, and fintech active consumer loans are also up 6%. So literally every business segment is growing. Now what's also interesting is on October 28th, Kaspi announced that it was buying 75% of Turkish e-commerce platform Hepsi Burada, I believe I'm saying that right, for about $1.1 billion. This acquisition gives Kaspi access to a new population of 85 million people, which is 4xing the company's total TAM. E-commerce penetration in Kazakhstan and Turkey are both still low as well, and the economies are growing quite quickly. This acquisition is also being funded by the cash on Kaspi's balance sheet, so no dilution or significant amount of debt is being used in this purchase. So this should be more so like organic growth, which I do think is a good thing. Now, I also looked into the insider ownership and really the ownership structure of this business, and I found that Mikhail Lamtads is the CEO, and he owns 24.6% of the company or the shares outstanding. Vyacheslav Kim is the chairman of the board, and he also owns 23.4% of the company's shares. So there is very high insider ownership, with these two executives owning nearly half of the company. Their net worths are also both over $5 billion, so these guys are multi-billionaires as well. Now, if we head back over to Stock Unlock and take a look at Kaspi's total revenue and its net income right here, then we can see that total revenue has compounded by about 38.7% since 2018, and the net income or earnings has compounded by about 46% annually. Now, as we zoom in, the compounded annual growth rates do drop slightly to about 35% revenue growth and 35% net income growth. But overall, this business is growing very well, and over the long term, it seems like it has consistently grown too. Here we can also see that Kaspi's price to earnings ratio is only 11, and it is paying a dividend of 6.3%. And this is a business that is also growing its revenue and earnings at over 20% consistently. So this is basically a business where it's trading for only an 11 PE and growing at 20%, which leads me to think that this stock is looking quite interesting and cheap in the market. Now, my hesitation with this business is I don't really know the politics or economics of Kazakhstan or Turkey, but at face value, when you take a look at the fundamentals, the insider ownership, the growth, and really just the overall market that this business is operating in, it does look quite attractive. And the price today does not look that high at all to me. So let's head over to Stock Unlock's discounted cash flow calculator, and let's say that Kaspi will continue to grow its net income by 15% annually over the next 5 years, Its dividend will also grow in line with the net income, and it will maintain an 11 price to earnings ratio. Now, with these metrics right here, we get a compounded annual growth rate to the shareholder value or share price of about 19.5% annually. And this net income growth rate of 15% is well below the company's historical average growth rates. And an 11 price to earnings ratio does look pretty cheap for this business since it is growing quite quickly. So for all of these reasons, again, it does look like Kaspi could be offering some pretty significant value in the market today, but I would definitely do more research into the actual business, the economy, and what its future growth potential may be. But at face value, again, it does have all of the things that I look for in a long-term investment. The growth is there, the price is there, the insider ownership is there, so it does really look interesting to me. All right, so now let's move on to the second stock that I want to talk about, and this one is the ticker symbol NICE. Now, this stock has been around for quite some time. It did IPO in 1996, and if we take a look at the returns over the past decade, the stock is up roughly 336%, and it has massively outperformed the S&P 500. However, the stock is currently in a 41% correction from its all-time highs, which again is making it look quite interesting to me. This screenshot is taken from NICE's website where it explains what they do and who the company is. So this says, NICE manages 100% of customer interactions, tens of millions of conversations every day, from voice to next-gen digital and AI chatbots, enabling organizations to orchestrate the complexity of modern customer experience on one platform. So NICE's main business and value proposition is to essentially handle customer service and customer engagement for other businesses. And they are now leveraging AI to create AI chatbots and AI agents to also handle the customer services and interactions with major businesses as well. However, NICE does have 3 different business segments, but again, their customer experience business segment is the vast majority of the actual company. NICE also believes that as of 2023, their total addressable market was about $11 billion. And by 2028, they are expecting their TAM to grow to $29.5 billion, which is a compounded annual growth rate of about 20 to 25%. So they do believe that they are operating in a fast-growing market as well. Now, what was very interesting to me when I was doing my research in this business is that NICE has 10 out of 10 of the top US health insurance companies as customers. They also have 5 out of 5 of the top US telcos, 9 out of 10 of the top global financial services companies, and 6 out of the 10 top Fortune 10 businesses. So it seems like they have some major customers on their roster, and these major businesses are continuing to use their services as well. Now, on this next screenshot, we can see the revenue breakdown by business segment, and we can see that as of the most recent quarter, they produced about $578 million from their customer engagement segment and about $111 million from their financial crime and compliance. So about 84% of NICE's revenue comes from its customer engagement business, and this is also where all of the growth for the business is coming from. For example, in the first quarter of 2022, their financial crime and compliance business units generated $106 million in revenue, and by the third quarter of 2024, they only grew revenue by about $5 million to $111 million. So the vast majority of this business's growth is coming from its customer engagement segment of the business. So then I went through NICE's most recent quarterly report, which was the third quarter of 2024, and here we can see that total revenue growth for the business was 15% year over year. Cloud average recurring revenue exceeded $2 billion, and they had record high operating margins driven by operating cash flow of $159 million. On a GAAP basis, total revenue was $690 million. Again, it grew 15% year over year. Cloud revenue increased by 24%, operating income increased by 24%, diluted earnings per share increased by 34%, and operating cash flow increased by 32%. So as of the most recent quarter, NICE is posting some pretty dang solid results and growing its revenues and its profits by over 15% annually. This next screenshot also says cash flow and balance. Third quarter 2024 operating cash flow was again $159 million. In the third quarter of 2024, $86.4 million was used for share repurchases. As of September 30th, 2024, total cash and cash equivalents and short-term investments were $1.5 billion. Our debt was $460 million, resulting in a net cash and investments of $1.068 billion. So this company is generating a lot of free cash flow, and it's using that free cash flow to buy back shares right now. And additionally, the company looks like it has a very healthy balance sheet with over $1.5 billion in cash and cash equivalents and only about $460 million in actual debt. This next screenshot is NICE's most recent cash flow statement. So right away, we can see that operating cash flow in the most recent quarter was $159 million, again, as we've already learned. However, last year for the same quarter, it was 120.6 million. Year to date, NICE has also generated $583 million in operating cash flow versus $381 million last year. We can see that the business does do quite a bit of stock-based compensation though, with about a third of operating cash flow being stock-based compensation, which is definitely something to note. We can also see that the company's purchases of property, plant, and equipment or capital expenditures was only $10.4 million in the last quarter, which means that they did generate about $149 million of free cash flow as of the last quarter. Year to date, NICE has also spent only $27.4 million on capital expenditures, which means that they have generated over $550 million of free cash flow so far this year. Now, if we take a look down here, we can see that the company bought back the $86 million of shares in the most recent quarter and $274 million worth of shares so far year to date. So the company is using a large portion, well, about half of its free cash flow to buy back shares right now. Now, if we head back over to Stock Unlock and take a look at this business's revenue, we can see that it is currently sitting at an all-time high. And over the long term, this business has clearly compounded its revenue very, very well. In fact, since 1996, the revenue has grown at a compounded annual growth rate of about 18%. If we also take a look at their free cash flow, we can see that free cash flow in the trailing 12 months has hit an all-time high of about $668 million. And let's zoom into about 2014, and we can see that over the past decade, free cash flow has also compounded by about 20% annually. So NICE's revenue and free cash flow is continuing to grow and hit all-time highs, and it seems like the revenue and cash flows are also compounding at pretty dang solid growth rates. Let's now head over to Stock Unlock's freeform tool to take a look at NICE's price to free cash flow today versus its long-term historical averages. So right now, NICE is trading for a price to free cash flow of only 17.7, and its 10-year historical average is about 25.6. So this business is trading well below its historical average price to free cash flow right now. And again, its revenues are continuing to compound, and so is its free cash flow. Also, a 17 price to free cash flow for a business where the revenue is growing at 15% and cash flows are growing at about 30% right now does look very interesting to me, especially when the business also has a very strong balance sheet. So based on this business's fundamentals, it actually does look very interesting in the market right now and could potentially be looking quite cheap as well. Why I think that the market is bearish towards NICE stock right now and kind of pricing it pretty cheap is because there is a lot of talk about AI chatbots and agents becoming more commoditized. So basically NICE's main business proposition and value proposition is that they handle the customer engagement and customer support for other businesses. But if AI chatbots and these new AI customer support companies can actually take market share or build a similar product quite easily, then that could kind of disrupt NICE's business. And I think that might be why the market is bearish on NICE right now. However, when you take a look under the hood and you take a look at the actual fundamentals of NICE, you can clearly see that the revenue and cash flows are continuing to grow, and they are sitting at all-time highs right now. And picture yourself as a top 10 bank in the United States, which is a customer of NICE's, right? You're not really going to go out and try and build your own AI chatbot customer engagement agent. And you probably have been using NICE for over a decade now, and you're probably not going to be thinking about switching from NICE to another brand new AI startup. So basically what I'm trying to say is there probably is some goodwill there between NICE and their long-term customers. And I don't necessarily think that their customers are trying to build some in-house AI agent to handle their customer service when they're currently doing that through NICE, and NICE has been doing it for a very long time. NICE also is developing their own AI agents and leveraging AI to improve their customer service. So I do believe that there could be an argument there that NICE does have a moat and their business is not going to be easily disrupted. And, the company's fundamentals are continuing to grow. So I think that when you look at the financials, they're also suggesting that NICE's business is not being disrupted. So for all of those reasons, I do think that NICE is looking quite interesting in the market today. And that is why I wanted to include it in this video. All right, so now let's move on to the third stock that I want to talk about in this video, which is HIMS, or Hims and Hers Health Inc. HIMS is a telehealth consulting platform that also offers digital prescriptions and delivery of those prescriptions. The telehealth platform covers everything from the intake, review, treatment selection, delivery, support, and customer service. I first started covering HIMS in my September video, and it's up roughly 150% since then. However, I do still believe that the stock is potentially looking undervalued. Hims has seen 175% growth in personalized subscriptions, which means that more and more people are using Hims' personalized services, which is increasing retention and stickiness of its customers. Hims' total subscribers are up 44% year over year, and the revenue per subscriber is also up 24%. So every subscriber, on average, is buying more prescriptions from Hims, and Hims is also growing its subscribers at a very fast rate. In fact, Hims is taking massive market share in the US telehealth space. Hims had 14% market share in 2020 and now has 49% in 2024. 54% of newly observed customers are choosing Hims as well. So Hims has half of the existing market share and over half of the new entrants that are coming in and becoming new customers. They're doing extremely well and clearly winning over their competitors, which I think is building a moat for Hims. In their most recent quarter, Hims also gave us their outlook for the fourth quarter and for the full year. So for the fourth quarter, they're projecting 90% year-over-year revenue growth, which is just insane. For the full year of 2024, they are expecting revenue growth of 67%, which means that the revenue growth is actually currently accelerating. Hims also has an 85% retention rate on their customers, which is very high for a consumer platform. So now let's take a look at Hims' income statement as of the most recent quarter. And we can see that they did about $102 million in revenue, which was up roughly 80% year over year. Now, what's interesting is we can see that Hims' marketing expense is $182 million, which is almost half of the revenue that the business generates. And so far year to date, Hims has spent almost $460 million on marketing. So marketing is very clearly the number one expense of the company. And why I think that this is interesting is because marketing is kind of like an optional expense. I do think that Hims' marketing is working very well because the revenue is growing at 90% year over year, which is insane. So clearly them spending money on marketing is actually paying off. But think about it. If they wanted to, they could cut their marketing expense in half, still be doing about $90 million in marketing per quarter, and they could save roughly, what would that be, $360 million per year. This would probably cause the company's revenue growth rates to slow down, but they would generate another $360 million in annual free cash flow just by turning off a switch, basically. So I think that there is a very high profit potential for Hims' business, especially if they just, cut down their marketing expenses. Also, the last time that I discussed Hims on my channel, people pointed out that on the income statement, there is this $52 million benefit from income taxes, which increased Hims' net income to about $76 million on the most recent quarter. Now, why I think that this isn't really something to consider is because I don't look at net income. If you guys know, on my channel, I only look at net income on banks or financial businesses. And for the rest of the time, I do believe that cash flow is a much better metric. And here's why. So if we head over to the cash flow statement, we can see that in the operating cash flow segment, they remove the $54.3 million benefit for deferred taxes because it's a non-cash expense, essentially. And even when we remove this $54 million deferred tax benefit that was on the income statement, Hims has still produced $165 million in operating cash flow in the first 9 months of the year, versus $51.5 million in operating cash flow for the first 9 months of last year. So operating cash flow and actual operating profits is up 3x year over year, and the company is actually producing a lot of free cash flow. Their purchases of property, plant, and equipment was also $17 million so far year to date, so the company has produced roughly $150 million of actual free cash flow this year so far. They then used $78 million of this free cash flow to buy back shares, and I do actually like this because I do think that Hims stock, especially over the past year, or so far this year, has been quite undervalued. So now let's take a very quick look at their balance sheet. And right here we can see that they have cash and cash equivalents of $166 million and short-term investments of $88 million. Now down here, we can see their total liabilities are only $162 million, which means that Hims has more cash than total liabilities, and this company is very, very financially sound. So they're growing at 90% annually, they're producing a lot of free cash flow, and they have more cash than liabilities on the balance sheet. So now let's head back over to Stock Unlock and take a look at Hims' total revenue in the trailing 12 months, and we can see that it now is at $1.24 billion. But what's interesting is if we take a look at the quarterly revenue and then turn it into a percent change, we can see that in the most recent quarter, revenue has started to accelerate. And once again, in the next quarter, they are expecting revenue to continue accelerating. So this is a very interesting thing for me because typically as businesses scale, their revenue growth rates kind of slow down. But right now, Hims' revenue is actually picking up and accelerating. Now, if we also take a look at the trailing 12 months free cash flow, it is now sitting at $150 million. But if we take a look at Hims's free cash flow margin in the most recent quarter, it was basically 20% and it was at an all-time high. So this business is basically producing a 20% free cash flow margin now that the business is actually trying to focus more on profitability. So I did the math, and in the next quarter, if they can maintain a 20% free cash flow margin, then Hims could produce roughly $90 million in free cash flow for the next quarter. Now, if we take $90 million in free cash flow and we annualize that, multiply it by 4, then that is $360 million in free cash flow potential based on their next quarter projections, essentially. Now, Hims today is a $7.41 billion stock. And again, on an annualized basis on their next quarter, they could produce $360 million in annual free cash flow, which means that the business is essentially trading for about 20 times free cash flow, which I think is pretty cheap for a company that is growing its revenues at 90% annually, has more cash than liabilities, and is a free cash flow machine. And you also have to remember that their number one expense is marketing at about $600 million per year. Again, I think the marketing is working right now, but if they wanted to, they could easily cut that marketing expense in half and have another $300 million of free cash flow hit the bottom line. So I think the profit potential of this business is massive. I think that its price ratio, even on its profit potential today, even with the marketing expenses, is not that high. Because 20 times cash flows today in this market is usually what is valued or priced for a business that is not really growing, not for a business that is seeing its revenue accelerate and grow at 90% annually. So I think that there is still a strong argument that Hims stock is looking quite cheap in the market today. And for those reasons, I wanted to update you guys with my thoughts. So now let's move on to the next stock that I think is still looking interesting, which is Amazon. It's at $220 per share now. It is continuing to hit all-time highs, and this is a stock that I have been including in my monthly stocks videos for, I think, like the past 6 months, because Amazon, I truly do believe, is the most undervalued Magnificent Seven stock, and I do think that there is a pretty strong argument that Amazon is still offering value in the market today. So I'm sure we all know that Black Friday just happened, and I have been finding articles that say, US Black Friday spending at stores inches ahead as Americans spend more money online. Black Friday spending in US retail stores was muted this year in contrast to a more robust rise online. Sales at brick and mortar stores grew just 0.7% year over year, yet US e-commerce sales increased by a hefty 14.6% online. So what this article is saying is that a lot more Americans are still continuing to spend more money online, and the e-commerce segment of basically consumer spending is continuing to take market share and grow strong. And since Amazon is the number one online marketplace, you got to imagine that this is strongly benefiting Amazon's business. I also found this tweet, which is a quote from Amazon's third quarter financial transcript, which says, over 40 million customers this past quarter have had their orders delivered for free with same-day delivery, an increase of more than 25% year over year. Thus far, this new design reduces fulfillment processing time by up to 25%, increases the number of items we can offer for same-day or next-day delivery, and is expected to drive a 25% improvement in our cost to serve during peak with this next generation facility. It's still early days in how much automation we expect in our fulfillment networks. So basically what Amazon is saying here is that their same-day deliveries increased by 25% year over year in the most recent quarter, which is good. I think that this builds Amazon's moat. And then additionally, they are saying that they expect to see a 25% cost reduction in their fulfillment centers due to robotics, essentially. And they also said that they do believe there is further cost savings and efficiencies to realize through automation and robotics. So the story of next quarter, I think personally, is Amazon, well, US retail sales online grew by about 15% year over year. That's obviously going to benefit Amazon. Then additionally, Amazon is working to continue improving its efficiencies in its fulfillment networks, which ultimately means that its margins are probably continuing to expand. And therefore, with increased revenue growth and increased margins, we could see a nice quarter for Amazon coming up in the next fourth quarter here. This next screenshot also shows us that Amazon's highly profitable business segments have compounded all at over 30% over the past 5 years. This is AWS, Amazon Advertising Services, third-party seller services, and Amazon subscription services. And as these businesses continue to make up a larger and larger portion of Amazon's overall revenue, I do expect Amazon's margins to continue expanding over time. Amazon's gross margin has nearly doubled to 48% in the trailing 12 months now, since about 26% all the way back in 2012. Amazon's operating margin is a little bit more cyclical, but it is absolutely spiking right now, and it is sitting at an all-time high in the trailing 12 months of about 9%. And again, I do think that Amazon's profitability and its margins are only going to continue expanding. Now, if we head over to Stock Unlock's freeform tool, we can see that Amazon's price to operating cash flow is sitting at 20.6 today, and its long-term average over the past decade is about 27. So its price to operating cash flow is still well below its long-term historical averages, and I do believe that this is the best metric to value Amazon's business off of. I have explained this in other videos as to why, but yeah, I just think that Amazon stock is trading well below its historical averages. It's actually trading for a lower price to operating cash flow than the other Magnificent Seven stocks. I think that this business is going to continue growing over the long term. I think it has one of the best moats in the world, and I think that its margins are only going to continue expanding over the long term as well. So right now, while Amazon is trading below its historical average price ratios, I do still think that the stock is looking quite attractive, and therefore I am continuing to add it in my monthly stocks videos. All right, let's now move on to the fifth and final stock that I want to talk about in this video, which is Brookfield Corporation, or BN. If you are a regular viewer of my channel, then this should be absolutely no surprise to you, because Brookfield Corporation is the largest position in my portfolio, and since I started covering this stock all the way back here at the end of 2022 and at the beginning of 2023, it is now up more than 100%, and it has doubled, and it is continuing to sell near all-time highs. However, I do believe that there is still a strong argument that Brookfield Corporation stock is looking undervalued, so I'm going to run you through my quick logic there. This screenshot comes from Brookfield's third quarter 2024 earnings, and what I like to do is highlight in red boxes Brookfield's distributable earnings from their actual operations. They do have investments that they sometimes sell off and realize, and those are the blue boxes right here. So the blue boxes are essentially whenever Brookfield sells an investment for a gain. But this is not really consistent cash flow from the business, so I want to highlight the actual profitability of the business and its operations. And right here we can see that in the last 12 months now, it has produced about $4.6 billion in free cash flow. And in 2020, they produced about $2.1 billion. So free cash flow over at Brookfield has more than doubled over the past 5 years. On a per share basis, this is also the exact same story. And in the trailing 12 months now, they have produced $2.90 in free cash flow per share. This next screenshot shows us all of Brookfield Corporation's different businesses that they own. And we can see that the asset management business is now producing about $2.7 billion in annualized cash flow. So is their wealth solutions business. And in the most recent quarter, their wealth solutions cash flow grew by 100% year over year. So this business is growing incredibly quickly. And again, it's doing about $1.5 billion in earnings now. Brookfield's operating businesses produced about $1.6 billion in cash flow for the business. So on an annualized basis, Brookfield is producing about $4.8 billion in cash flow today. Brookfield also says, if we achieve the base plan, we should grow our distributable earnings before realizations and capital allocation by 17% to $10.1 billion over the next 5 years. So basically, Brookfield is expecting its free cash flows from its businesses to grow at 17% annually over the next 5 years. But then Brookfield shows us that when you factor in the realized gains on investments over the next 5 years and their capital allocation where they invest back into the business to actually grow the business, when you factor those two things in over the next 5 years as well, then they're expecting to grow their free cash flow by 25% annually over the next 5 years. So now let's head over to Brookfield on Stock Unlock. And we can see that Brookfield is currently worth about $91.5 billion in the market today, or about $92 billion if we want to round up. Now, this business is also producing about $4.8 billion in annualized free cash flow today, which is roughly 19 times free cash flow. Now, again, this business is projecting to grow its free cash flows by 25% annually over the next 5 years. So when I'm taking a look at Brookfield Corporation, I'm seeing a business that's trading for a 19 price multiple, and projecting 25% annual profit growth. And I think that this is a pretty low price to pay for a business that is projecting a lot of future growth. So for those reasons, I do still think that Brookfield Corporation is arguably looking cheap in the market today. And I am continuing to add to my Brookfield position whenever it is in these slight dips. So I'm an active buyer of Brookfield. I do truly believe that it is still cheap, even though it is at all-time highs. And I'm sitting on the most gains that I've ever had in the stock market on one position. But that is going to wrap up the 5 stocks that I think are looking interesting in the month of December. And let me know what you guys think about this video. As always, I try to include stocks that not a lot of people are talking about, or stocks that may be a little bit more obscure and, people just don't really look at. and I do think are still looking interesting in the market. If you did enjoy this video, as always, please remember to leave a like on it, as it does really help out my channel. And if you are interested in getting even more content from me, tracking my portfolio, seeing all of my buys and sells, and staying on top of my Patreon exclusive video series that I'm doing, like the Berkshire Hathaway Letter to Shareholders series, then consider checking out my Patreon. It's only $10 a month, and people have been saying that they've been getting massive value out of the subscription. I do my absolute best to provide as much value to my Patreon subscribers as possible. So seriously, check it out. I think that it is a steal at $10 a month, and I think that you'll love it. So yeah, go and check out my Patreon and consider subscribing and supporting the channel. But with all that being said, thank you all so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.